Hello and welcome back to Market Shares. I'm your host, Tony Blodgett, and today I'm going to talk about sales. Actually, I want to cover a presentation that I gave about a week or two ago to all of our loan officers, and this was I did a PowerPoint presentation. If you've ever seen me present before, you know I'm not a big PowerPoint guy, but I did transpose some of my notes over here, and I just think that this is such an important topic to cover. So I'm going to do my best to read off my notes and give you my take as well on what are the things that top producers are doing well in this market, right? I mean, you might ask a loan officer today, what are the biggest challenges going on in today's market? I mean, that's what a lot of people ask. And people talk about, interest rates being high, inventory being low, affordability being difficult. And I think the better question is, let's not talk about what's, challenging with this market. Let's talk about what are the people that are successful in this market doing that other people aren't doing, right? So that's really where I wanted to lead with this conversation is what are the things that are working in today's market. So I got a list of 5 things here that I think everybody should be focused on. And I know that not everybody is because I hear the stories day in and day out, right? I talk to loan officers all the time, and I think people still, even in this environment, are still so hung up on rates, right? And I get it. I mean, I talk about rates on this podcast. We try to, pontificate on what the market's doing and what's the direction of interest rates and when are rates going to come down. So I get it. Rates are an important factor, but they're not the only factor. And as you talk to more and more top producers, what you find out is the strategies that they are deploying are not interest rate dependent. And I think that's where you can find that, blue ocean, if you will, is where are the opportunities that nobody else is tackling. Now, we know who's going after the low rate environment or the lowest rate environment, right? It's your call centers. It's your consumer direct type lenders. It's, people that are really trying to make as little margin as possible on a loan so they can offer a little bit better interest rate because it's really the only thing that they have to offer. And I'll tell you, when I originated loans, I wasn't the cheapest guy around. Not because I worked for a company with high rates, but because back when I originated, you could set your own margins. And I did that, and I knew my value. And so I don't think any of us want to work for as little as possible. And how low can we go and still win the business because of our interest rate? So let's talk about the strategies that loan officers are winning with in today's market. And if you're doing these things, then I'm curious if you're also having success with them. Maybe leave a comment down below. And if you're not doing these things, maybe these are areas where you should start focusing more of your attention, because I do believe rates are going to get better and the market's going to get better. It just always does. This is a cyclical business that we're in, but I think these are areas where everybody could sharpen their tools. So the first one is dealing with the affordability challenges. So we know that the problem for many first-time home buyers is affordability. I would argue even many move-up buyers, the challenge is affordability because they're comfortable in the house that they have right now and they think the payment's going to be too high on the home that they may be purchasing. So what top loan officers do is they shift the conversation from the interest rate and they shift it to the payment, right? Now, we know about that. Like, this is what the car industry does, right? Like, you go to buy a car and like, well, what do you want your payment to be? And if I could get you that payment, and we all are kind of trained to be like, don't fall for that trick. But it's not necessarily a trick. The reality is that the average consumer makes their budget based on their monthly payment. So I think strategies that help reduce the payment are where top loan officers are focusing right now. Believe it or not, I surveyed a number of loan officers within our company, and the number one strategy that people are using right now, which kind of surprised me, was 1 year and 2 year buy downs. lender paid buy downs and seller paid buy downs. So that's like an old trick that, needs to just be dusted off. If you're not talking about buy downs with your real estate agents and your buyers, then I think you're missing the boat. Because if you could have a conversation with someone and said, look, if I could reduce your payment for the first 12 months by $500 a month or $400 a month or whatever that number might be, would that make a difference in your buying decision? Do you have anything happening in your life over the next 12 months that might be increasing your income over time? Are you going to get a raise? Things like that. So I think the buy down is a huge opportunity that people might be missing. And then using seller concessions, you guys, look, this is a conversation I'd be having with listing agents even, right? I mean, do the math for them and show a $20,000 reduction in price, which, by the way, I don't know if you're looking at the market, at least in my market, I see price reductions all the time, $20,000, $50,000, $100,000 price reductions. Higher end homes, $200,000 price reductions in some of the luxury markets, especially in Washington. There was an over inventory of luxury homes. What about presenting options to not necessarily do that big price reduction, but to fund a permanent buy down even for somebody, right? Advertise a significantly lower interest rate using the seller concession as the buy down. So I think this is an area where top producers, even if the borrower doesn't do the buy down, it's having the conversation with your borrower about ways of reducing their monthly payment through temporary buy downs, permanent buy downs, things of that nature. Now, I will just caveat this. Permanent buy downs, I think, can be a great solution, especially, if you remember, 3 years ago, we were talking about, marry the house and date the rate. And everyone thought, why would you pay permanent buy down? Rates are never going to stay this high. And well, we've had a few dips, but rates are still high. So, I think a permanent buy down becomes a little bit more of a reasonable conversation to have with somebody. But I like temporary buy downs. You use the seller's money, you get a bigger bang for your buck. And, most people's situations financially tend to improve over time. So anyway, tackling the affordability challenge right up front, shifting that conversation away from what's the rate today versus what's a strategy that's going to put you in a lower payment that's going to meet your needs a little bit better. So that's the first one. The second area that I see a lot of people focused on, this was the number 2 thing that came up when I was polling top producing loan officers. It's coming up with solutions for your move-up buyers. Most notably, it was buy before you sell. This is big time for people because we all know about the lock-in effect. And we all know that the lock-in effect of the low interest rates that were sold during, 2020, 2021, the COVID years, if you will, people are still locked into those homes. Now, we've seen that ease quite a bit because people need to move. Like we've talked about this, right? Their family size grows, their needs change, their job relocates them. They were working remote because that was the thing, and now their company wants them back at work, and now they're commuting 2.5 hours, and it's no fun for them, so they need to move. But people are very worried about not just not being able to afford as much of a home because the rate's higher, right? So you can still use some of those affordability strategies. They're also worried that they're going to list their home and not be able to find one because of limited inventory in many markets. So they want to buy first and then list their home and get that thing sold. So there's lots of strategies out there. I'm not going to go into these in detail, but many investors will do loans where they exclude the payment on the departing residence from your debt to income ratio. If you don't have a program like that, I would find an investor that has that program because they absolutely exist with multiple different investors where you could exclude the departing residence from your debt ratio. You can even take out a home equity line of credit with some companies against their departing residents and then not use that payment in their qualifying ratios for the new purchase. The list goes on. Point is that there is a lot of strategies right now that top producers are using that are all geared towards I can help you purchase your new home without having to sell your old home first. We also have cash buyer program. There's others out there. So this isn't a specific to what we offer, but I'm just telling you, these strategies are universal if you can find the right resources within your company or your channel of doing business, whether you work for a bank or you're a broker. These products are out there. You got to get your hands on them, because helping move up buyers buy before they sell is a big strategy right now. Self-employed borrowers, right? We've talked about non-QM a lot on this podcast. I am very bullish on non-QM. I was saying that I think in the next couple of years, it's going to be 27 to 30% of overall mortgages are non-QM. I just heard projections from, I forget who, but someone very notable, I'm sure, but that 35% is what they're predicting. 35% of all mortgages being non-QM. And I believe that that's possible. And the reason I think that is because it's not like you're looking at people right now through the lens of non-QM. I think there's a lot of borrowers that are either not applying for loans because they don't know that these loans exist, or loan officers that are not identifying that there is other non-QM solutions for the borrower sitting right across the desk from them when they're doing their pre-approvals. So focusing on first-time home buyers and self-employed borrowers, and educating the self-employed community that these loans exist, whether that be through social media, training classes, work with your real estate agents and referral partners. This is where I'd reach out to a CPA, financial planners. They probably have a database of folks that are self-employed that don't know all the options that are available in the non-QM space, because it is a growing part of the market. So they're focusing on self-employed. And then thinking beyond primary residences, right? This is where another non-QM product comes in, which is DSCR, right? And it's not just DSCR, but when it comes to investment property financing and cash out refinances to purchase more, rental properties, things of that nature, DSCR is a huge tool in this space. But there's plenty of other strategies around helping people buy investment properties, and plenty of people are still looking to build out their portfolio. So I would get into social media groups that are specifically designated groups for investors. I'd be focusing on real estate agents in my marketplace that work with a lot of investors and specialize in rental properties, things of that nature. So I think that you can be targeted with your prospecting, looking for non-owner occupied types of transactions where DSCR comes into play, and some of the other non-QM options that are available. Again, not nearly as rate dependent, and a big source of business. A lot of refinances, a lot of cash out refinances in that space. The last one I'll mention, the fifth one here, is construction, renovation, and reverse mortgage. I'm just kind of lumping those together. I would consider these specialty type products. I would not just go out and try to originate these if you've never done one of them. This is a product you want to learn, right? You want to maybe even work with a mentor, work with someone in your company who does specialize in these, and share in the revenue or share in the compensation on that for your first couple loans. Understand what you're doing, because these can be reputation killers if you don't do them right. But there is good business. It's not nearly as rate dependent. And there's opportunities where there's low inventory, so people want to build their own home. So construction, renovation, right? People, they love their house. They want to move up. They don't see possibilities. So maybe renovating their existing home is a better solution. And then reverse mortgages. Like I've talked about this so many times. I think this is a massive opportunity and a growing opportunity right now, as we have more and more of our baby boomers that want to age in place. They have tons of equity, and a reverse mortgage has a bad stigmatism. It's up to us to educate people on how this product actually works, and it can bring so much relief for the later parts of many of our seniors out there who are already homeowners and have good equity but limited cash flow. I'm a big fan. So those are the areas, you guys, that I see the best loan officers focusing. They are not just out selling loans based on having the lowest rate. That strategy doesn't work. it is like banging your head against the wall. We have to be better. We have to come with ideas, strategies, solutions, ideas, and the right programs. You have to have access to the programs and not just know that they exist, but understand how they work. Because just as quickly as you coming up with a great idea, if you fumble the ball getting that loan closed because you don't know how the program works, you're going to be taking 2 steps backwards. So understand these programs. If your company's offering training, if your MI company's offering training, if there's opportunities to learn about these, there's probably YouTube videos that you could go watch. Understand how these programs work, because everything I talked about today is a little bit out of the box, but that's what it takes. That's what it takes right now to get that competitive edge. So look, we know this industry is changing. It's evolving. Does it get back to normal someday? I don't know. What's normal anymore? I mean, gosh, we came off of COVID. That wasn't normal. Then we came into this. So I think the idea of normal is probably out the window. But if you're the loan officer who's creative, you identify problems, you solve those problems, you think outside the box, yes, having a competitive rate is important, but it's not the only factor. Change your mindset a little bit about the value that you bring to the marketplace, and I promise you, you're going to win more business. So I hope this gave you some ideas. Put down in the comments which of these strategies are you deploying, and if you think this video was worth the watch, please consider subscribing to the channel. But more than that, tell somebody about Market Shares. Share this episode with them. Tell them to check it out, and I'll see you on the next one. Take care.